Hey, welcome to today's tech tip. We are going to be going over options and what we're doing right now in the market with Etha, as we're going to use that as an example. Now, if you're new to the options game, don't get stressed. There's a lot to this, but we're going to simplify it to kind of the methodology that we're using right now so you can follow along a lot more easier to see exactly what we're doing. Now, on my screen, I have the Etha option chain open. Now, this is over at E-Trade. Yours might look a little bit different if you're using any other brokerage, and it really doesn't matter what brokerage you use, but they're all pretty much the same with some small minor changes in the way that they show their interface or they display their options. So let's go over each one of these things that you need to know for selling puts, because that's what we do most of the time. Now, there's three things that you see on the screen right here. Obviously, we have the Etha symbols, what I have pulled up, and this is the last price that Etha traded at. It's important to know that because we're going to be able to calculate the intrinsic value, which is very important, and we're going to be able to track the time decay or the volatility value that's in the option that we're trading. So we're going to take a look at the price right here. And then we're going to look at the option chain. Here's the option chain. On the right side, we have puts. On the left side, we have calls. Now, primarily what we do is we sell puts. And these are typically close to at the money puts. And I know you guys have heard that a little bit, but what does that mean? At the money is the strike price. The strike is the underlying asset price, which is 1980. So at the money would be both strikes close to the 1980 price. So the $20 and the 1950. This purple line actually represents where the stock price is, and it's between those two. So you can kind of see that there. Now, what we need to go over is the actual process of selling a put, because sometimes that's a little bit difficult to understand. So let me go ahead and erase this. And we're going to use the $20 put as our first option that we're going to sell and give an example of. Now, if I go ahead and I click this right here, it'll fill this in for me on E-Trade. On other platforms, it might not, and you'll have to put this in manually, but let me walk through what it's saying here. So the strategy that we're using is we're doing a put. That's obviously put right here. It says we're doing a put. And what we're going to be doing is we're going to be selling to open. Now, this isn't a naked put because we have to have the cash reserves to be able to do this. So there's actually a safer side of doing options. And you can select your quantity here. So how many puts we're going to sell. And we're going to walk through that when we do the math a little bit later. And then this is the expiration date. Right now it is June 3rd. And so the expiration date is 3 days away. So the further out you go, the more value, the more time value you're going to have in each of those options. The strike price is the level at which is the price at which you're selling the put. So right here is the strike price, and we're doing the $20 one. And I'll explain what that means also when we do the math here in just a second. Obviously, it's a put. Now, the bid ask is the spread between what buyers are willing to pay for this put and what sellers are willing to sell this put for. Okay? Since we're selling to open, we need to look at the bid because that's currently what buyers are paying. So we're going to use that when we do our math. So if I have a chicken and I want to take it to market, I can only sell it for what buyers are willing to pay for that chicken. The same thing here. Buyers are right now offering 54 cents for this put. So I could instantly get 54 cents. Now, I could go in the middle somewhere and hope that it fills somewhere in the middle between 54 and 62, but it's not likely. And it's really unlikely that it's going to sell at 62 cents because everybody else is asking 62 cents and people are bidding 54 cents, which is actually an 8-cent spread, which is quite a bit. And then you can also see the last price that it traded at is 52 cents. So you're going to be in and around there. Now, when I'm setting up this put, what I'm going to do is I'm going to select a limit. And like I said, you can try to go for 55 cents and hope that it fills, or you could sell it right away at 54 cents. If I have a little bit of time, I'll go ahead and I'll put 57 cents somewhere in the middle, watch it for a couple hours and see if it fills. And all I would do is hit preview order and then confirm, and that would go through. And that's how we sell a put. Now, let's walk through a little bit of the math of what we make on this. Now, if I do right at the bid, obviously it's going to make $54 minus the commission, $54 minus the commission. And you're just like, well, it's 54 cents. How does it make $54? Well, let's go through the math on how that kind of works and what that means for our value. Okay, so I have this pulled up here. Let me go ahead and plug the price in. So the underlying asset price is $19.83. Okay. Let me see if I can move this up just a little bit. Yeah, we'll move it up right there, actually. Okay, that didn't move it much. The strike price I have in here at 20 cents. The put price is 54 cents. Now, what that did is calculate for me on my spreadsheet the intrinsic value and the time decay value. The intrinsic value is always your strike price minus your underlying asset price, which in this case is 17 cents. Okay? The difference between the put price and the intrinsic value is your time decay value, or your volatility. Now, I can reasonably assume that if the stock were to not move, let's just say it ends Friday afternoon, which is when expiry is, if the stock is $19.83, I'm still going to have an intrinsic value of 17 cents, but my time decay value will be 0. Okay? So that means I will actually profit the full $37. Why? Because on Friday, I will have to buy back this put at 17 cents or get put into the option. But we would rather buy it back at 17 cents and move on and make the full 37 cents. So in these options, you're always going to make the time value will always, or the volatility will always go to 0. And that's what we're basically trying to make on all of these options, because they will go to 0. The intrinsic value will not always go to 0. It'll go to 0 if the strike price is at or below the underlying asset price at the time of expiration. So what that means, if ETH were to move up to $21, then we would have a negative intrinsic value, which essentially would mean 0. So the rest of these numbers don't work in this scenario because I didn't do the math for them. But basically it would be 0, and we would make the whole 54 cents on this example, okay? So I would calculate this differently. But let's just say that it went to $20.01. It would still be 0, and we'd make the whole 54 cents in this example, okay? So don't pay attention to these numbers down here, because I'll do that differently when I'll show that. If the stock ends up going down, we actually make the entire, so we'd actually make the entire 37 cents, but because the stock price went down, you always have to do for the intrinsic value, you have to do strike price minus underlying asset price. So the intrinsic value would actually be $1. So on Friday, I would have to actually buy these back for $1. And for the time being, I would show a small loss of 46 cents per option contract. But I'm going to explain how we're going to roll that into the next one here in a minute, and how that's not going to eventually be a loss. But for the time being, it would show a negative on our account because we have to buy it back for more than what we sold it for. So if the stock goes down, that's what's going to happen. So, but let's just assume, for all intents and purposes, the stock stays exactly the same. Then on Friday, we'd have to buy it back for 17 cents, and we'd made 37 cents in time premium, which actually ends up being 1.85% gain. Now, remember, our cash requirement for this put is the same as the strike price times 100. Every single contract requires you to do, it's basically 100 shares of stock that you're representing with each contract. So your cash requirement for this strike is $2,000. So if you happen to have $5,000 in your account, you could sell 5 of these puts, and you would essentially, at the end of the week, make $185. Easy peasy. if the stock remained the same, because you'd have to buy it back at 17 cents. Now, if the stock went to $21, you would actually make the full 54 cents times 100, and you would make that times the 5 contracts you sold, which is $270. So as long as the stock goes at above the strike price, you're just fine. Now, if it goes below the strike price, then we have to do what we call a roll. And so I'm going to go ahead and talk about that in a second. Now, let's assume that everything is hunky-dory. The underlying asset price goes to 20. We make the 54, the full 54. It's like perfect scenario, whatever. And this thing expires absolutely worthless. There's zero intrinsic value at the end of the week, and we make $54 profit. Then we have $270 weekly gain for the week, which is great. Okay, that's like perfect scenario. It probably never happens. Most of the time, it'll probably stay in or at or close to the same price, or it'll move against you or whatever it is. And so you'll end up making like the 37 cents times 100, which isn't bad either. It's a pretty good gain for the week, 1.85%. Now let's assume we're stuck in a put that went against us, or it went down in price, and we have to do a roll. So I'm going to show you what a roll is, okay? Actually, yeah, first things first, let's show you what a roll is, okay? So what we would do on a roll is we would actually do the inverse. Now, I think on you can actually put a roll on when you go to your option chain. There's a button that says roll, but I'm going to show you both sides of a roll so you kind of understand. And since we sold to open, the starting leg of a roll is what we're going to do is going to do the exact opposite. We're going to buy it back. Okay? So what we're going to do is we're going to buy to close. Okay? So that's the first side of the roll. Now, this is going to cost us 61 cents. And we're going to roll to the next week. So I'm going to click the June 13th. Okay? And I'm going to look at the same strike, and I'm going to sell to open that one. Okay? So that's exactly what a roll looks like. Okay? And this calculates it for us, which is kind of nice. So 61 cents is what I would buy it back for, and I would actually sell it at 95 cents, which is 34 cents, which it calculates here at the bid. And like I said before, on a roll, you could actually go somewhere in the middle and hope that you get the middle somewhere. And going at the ask is crazy because you probably won't ever get that on a roll. So what are we doing here? We're buying back the first option that we sold, the June 6th, $20 put, and we're buying it back for the ask, which is 61 cents. And we're selling the June 13th, which is a week later, $20 put, and we're selling that for 95 cents. So we're actually making an additional 34 cents in premium. And if that stock would have moved against us, it gives us a little bit more time to roll that option and get into that stock just a little bit later. Or to get that sold a little bit later, and we'll buy to close a little bit later. So what that could do is that would, let me pull up our math spreadsheet here just a little bit. What that basically does is the underlying asset price is the same, as we can see here, right here. But what's going to change is our strike price is the same as well, as you can see here. But the put price, instead of 54 cents like it was, even though it changed because things have updated and the stock's, it hasn't gone down. That's really weird. It went up just a little bit. The put price is actually going to be instead 95 cents. So all we did is the intrinsic value stays the same. So if you're rolling to the same strike, you're still going to have the same intrinsic value, but you're going to give yourself a little more time value and decay. So even if the price of Etha were to dip really bad, you could always continue to roll, and you'll pick up time decay value every single week that you roll. And eventually you'll realize all that time decay and volatility when it finally pops back up and you're able to close out of that option when the strike price gets back to $19.83 or $20, which is when the underlying asset price gets back to $20, which is what you want. So in this scenario, if we were to buy a week out and roll into this, eventually, no matter what it does this week, even if it drops down to 90 cents, 19 cents, even if this popped up to, let's say, for example, that this popped up in my scenario. Let's say the Etha went down to $90 and the intrinsic value was a dollar. On Friday, the ask on this would be exactly $1. And so you're thinking to yourself, well, I sold at 54 cents and I have to buy at $1. That's kind of crappy, right? But this next week one would actually be able, you would actually be able to sell it for probably $1.30. Okay. So as you roll, even though you're buying this back for $1, you're selling this one immediately for $1.30 and you're getting a 30-cent spread. So you do the 30 cents plus the original 54 cents that you sold for, and it's 74 cents. But remember, you're kind of net negative at the time because you have to buy this one back for probably $1.37 is what it's probably going to be, okay? And so you're net negative in the account until Etha moves up. But you never really lose money on the put until you close everything out. So you can always wait, since Etha is moving up in an upward trajectory, you can always wait until Etha moves up to the point where you can cash this out and buy this back for basically 0 cents or 17 cents or 10 cents when Etha gets back to $19.83. You can always buy it back for 17, and then you'll realize the profit on the full 54 cents plus 30 cents, which is 84 cents. In this case, 78 cents because the math was just a little bit different. So you'll always eventually realize the profit on all the spreads that you kept rolling. And we'll see that kind of play out in some of the scenarios that we do over time. So you'll see some negative realized numbers on some of the trades because when you do this leg right here, sometimes there will be a negative where you have to buy that leg and sell this leg for a bigger premium, but you'll eventually realize the premium down the road, which is kind of cool. Now let's go back to our original numbers here. Now this one is 54 cents, is what we originally, it's actually 56 cents now, so let's just put 56, which isn't too bad. So $39 profit, a gain of $1.90, 1.95% per week, which isn't too bad. Now, a lot of people are like, well, let's do some math on that, okay? Because I think it's kind of cool. When you're doing $1.95 a week, 1.95% a week, this is how it calculates out. If you have an account value of $10,000 and you get 1.95% on week 1, you have an ending balance of $10,195. You can then use that much for week 2. Now, with options, I know you have to do the full options, so it might take a few weeks to build up, but let's just assume you have a big enough account, or percentage-wise, I want to show you compounding each week so that you can kind of see that and see how it plays out. Let's just assume week 2, you have the same gain as week 1, 1.95%. We're just going to keep that real. So what would you have at the end of week 2? Okay. You wouldn't have 1,195. You'd actually have a little bit more. You'd have 10,393 because you have this plus your $198 gain that week. It's a little bit more than 195 because 10,195 times 1.95% gain actually grows a little bit. It's a little bit bigger that week. So then this ending value of week 2 then becomes your starting value for week 3, okay? And so on and so forth. So we can kind of run this math down. Let's just say you make 195 the third week and you kind of boom. Then you make a little bit more for week 3. Just to show you the compounding power, let's drag this down to week 52. Let's go 52 weeks, shall we? Boom. So that would be line item 53 here, which is kind of cool. It shows that your account, even though you're only making 1.95% per week, by the end of week 52, which is 1 year, you'll have $27,295.32, which isn't a bad little gain just by getting 1.95% per week. Which, if you look at the volatility and the spreads in the options, that's actually not that crazy, considering this is a right at the money call or put that we sold on ETH A, and that's kind of how it would work out. So, hopefully that kind of walks through and kind of shows you the possibility and the potential just by selling these puts every week. Now, every week you might not close out everything because you'll have to do this roll and roll into the next week. So this roll, the way this would work out, obviously, I could hit the bid and it would fill that in for me, and that's going to fill right away. I could hit mid, it probably won't fill right away, or I could hit the ask and it will probably never fill. But if I just did the mid and I wanted to wait all day, it would probably get me somewhere in the middle there. It would probably buy this one back for me at about 58 cents, and then it would sell this one about 97 cents. Okay? And so it'd get me that 40-cent credit. And I could do that and roll to the next week and give myself a little bit more time to realize the full amount of what I sold, the full option volatility of what I sold. And if Etha continues to move against me, I can keep doing that every single week until eventually Etha starts to come back. And in the meantime, every single week that I do that, I'm going to be realizing time premium that's going to be decaying slowly over time. Now I have a little image to illustrate time premium, and since we're in the last little bit of time premium, you'll notice that this stuff starts to decay really quickly towards the end of when an option expires, which is really important to know. So that's why we're kind of trading and selling these last couple weeks of the puts, because that's when the most rapid time decay happens. And you'll notice, even if I go back to where I show this, where this one has about 47 cents of time decay or whatever it is, actually 40 cents of time decay, that's going to drop off. There's only 4 days left, about 10 cents a day. But it's not even. The first few days are going to be 6 cents, 6 cents, 7 cents. And then the last day it's going to drop 14 cents, give or take. And just drop off like crazy. And you get to realize all that time decay, which is all we're trying to do with this strategy. Now, hopefully that kind of showed everything. So I'm going to walk through and summarize again everything to do. So when we say sell a put, all you do is you click on this bad boy. Let's go back to the weeklies. Click on this bad boy, sell to open, 1, strike price. Oh, whoops. We're going to do the 20. See how it has both of those? We're going to do the 20 put, and it's going to sell at 56 cents. Easy peasy. And when we buy that put back, let's just say we're buying the same put back and nothing's on there. Let's take that off. All we would do is go back, click that, hit buy to open, buy it back, and we would buy it back at 66 cents. Now, in the meantime, obviously, if this is Friday, this is going to be a lot lower price. So we're going to buy it back at cheaper price. And you can basically see how to do that. It's very simple. Hopefully this helped you understand some things. I know there's going to be some questions, and we're going to go over those in detail, each little part that we need to. Anyway, if you do have questions, put those in the comments. I'll read through all those, and I'll try to answer those more succinctly in the next video here on options so you guys can understand that. And for now, take it easy, and we'll see you in the next one.